One of the characteristics of our portfolio, at a portfolio level, when we think about construction, the return on capital employed of ITIS has always been above 1.5 times the cost of capital. What do I mean by that? Just because you get growth doesn't mean that it has to translate into shareholder IRR. That growth means a good company translates earnings growth into cash flows. And promoters or the management teams reinvest those cash flows. We as minority shareholders would only make those returns when the incremental returns of the management reinvests exceeds your cost of capital. For us, at a portfolio level, we want that to be roughly 1.5 times cost of capital or expanding towards that. That's how we think about the strength of the portfolio across time. One of the things, while I told you about the 7-year track record and us beating Nifty fairly consistently across time, what gives us the right to believe that we will continue to do it, right? And this goes back to the fundamental aspect of how the portfolio is constructed. If you look at the long-term trajectory of ITIS and the long-term trajectory of Nifty, which is what we aspire to beat consistently, you will see two characteristics. You will see the fact that the cash flow generation at ITIS has always been consistently higher than that of Nifty. And the cash flow generation of, the return on incremental capital at ITIS, again at a portfolio level, has always been consistently that of Nifty. Now, on a quarterly basis or a semi-annual basis, there might be oscillations, but we don't react to quarterly or a semi-annual. For us, it's about seeing the trend and ensuring that at a portfolio level, even if there are one or two companies in the portfolio that go through headwinds, at a portfolio level, the structure doesn't change. And that's the importance of portfolio rather than just focusing on stocks. Now, the same thing, if you break down what percentage of the portfolio falls under what part of our bucket, this is where the difference comes. Where from a consistency-based perspective, over 3-5 years, which is what I would tend to call as medium term, you would see that more than 80% of the portfolio has what I call 1.5 times higher return on incremental capital, at least, than the cost of capital. Whereas that number for Nifty, as we speak, on an average basis, is more like 54%. Now, today, as you go down the lower market cap curve, many of the companies may not show this level of consistency. So one of the reasons I've always said that consistency is more important than one particular year of extremely strong returns is primarily this. Because I, as a fund manager, don't know which year you're going to get abnormal returns, and I can't predict that. But what I can do is to ensure that as long as you stay invested for 3, 4, 5 years, those returns come back into what the mean normalization is. While a particular year, like we saw underperformance in the fund in 2022, where earnings still grew at 19%, but our returns ended up at 3.5%, which is what prompted me to write that note in December 22, saying that this portfolio is extremely underpriced. While as an investor, psychologically, you want to invest in a rising market. That's how humans tend to react, and that will never change. Our aim is to also explain to investors when the stability of the portfolio does not get tested, and it's only the price that gets tested, why it is a good time to add capital.